Welcome back, everybody, to the Financial Advisors Workshop. And this is the show where we talk to top financial advisors all across the country and learn from each other by doing that. I'm your host, Brian Castle, and we have a gentleman from a city I know very, very well, and we have lots of clients and lots of activity in Wilmington, Delaware, and his name is Jim Lee. Jim, welcome to the Financial Advisors Workshop.
Hey, great to see you again, Brian.
Yeah, and you pointed out earlier that we just saw each other 2 weeks ago or last week at the National Association
Chicago. Yeah, right.
In our headquarters city of Chicago.
Yeah, and it's a great group of folks. I've been involved with them for about 4 or 5 years, and it's just this wonderful sort of tribe of financial advisors who are actively engaged in the process of managing client portfolios. And it's great. You get to share tools, tips, and techniques, and the occasional toy as well. So it's all good.
Well, and the contrast there would be many financial advisors don't manage money. They manage the process, they manage planning, they place money with managers, but they're not actually making the buy and sell decisions. But I do, and you do as well, Jim.
Yeah. There's a place for advisors who want to focus on financial planning and wealth gathering. And I have done that traditionally earlier on in my career. I just find the investment management process to be really interesting. And it's a value added for my clients.
Yes, exactly. Well, great. Well, good. Well, so this is obviously a senior level in the industry if you're a money manager, investment manager, as well as advisor. So, but how do we get here, Jim? Why don't we talk a little bit about and how did you get into the business and what made you get in?
Yeah. Well, my family is sort of a combination of bankers and scientists, as it were. So instead of talking about sports, we always talked about money and science stuff, right? And I always knew I wanted to be involved with investments and money management. So my first job coming right out of college was with what is now Ameriprise, right?
Okay.
Doing conventional financial planning, gathering assets, working with clients, and they teach a lot of really good skills. I did that for a few years and wanted to focus on the investment part. So I worked for a multifamily office servicing primarily the DuPont family, who's been around for a long, long time. They're on their 6th and 7th and 8th generation of wealth now. Not a lot of people know this, but the DuPonts kind of came into being during the War of 1812 when they sold gunpowder. That's where the original family fortune came from. And I did that for 14 years, got bought out by a bank, and then I started StratFI 12 years ago.
And so it started with a bank, and then I made the transition to StratFI. And so what was your thought on starting StratFI? Why did you do that? Why did you leave the bank?
Sure. Well, whenever you have an acquisition, things aren't quite the same, afterwards. And I really wanted to stretch my wings as a futurist. I have a graduate degree in foresight from the University of Houston. And what I have now is a boutique investment advisory firm focused on what happens next, right? And the idea is if you want to be in the right place at the right time, it's helpful to show up a little early. And
yes. So that's interesting. So yeah, so share more about foresight. And you told me there's a group and everything. Let's hear a little bit about that.
Yeah. There's a professional association. There are about 800 of us worldwide. And we go to all sorts of interesting places to have meetings. We were in Dubai last April for the 20th anniversary of our group. And they are really fun people that generally do speaking, they do consulting, and they do writing. So for my part, I do a fair amount of speaking. I also have a book that's out, Foresight Investing. Here it is. Which got some recognition a year or two ago. And I leave the consulting to the futurists. I'm busy enough just managing money.
Okay, great. So did you bring over clients from the bank, or did you start fresh at work?
Yeah, I had a non-compete agreement.
Okay.
And they had a good setup in that they really did everything from tax preparation, legal, bill paying, and investment management. And some of those clients needed all of those services. So during my non-compete period, I wrote my first book, got that out. I let people know where I was, but I didn't chase them down. My philosophy is I'd rather be a magnet than a hook. And if
Mhm.
you do things that are interesting, then people will look for you and they'll follow you out. So that's what I did.
And that's how. Okay. So how did the growth of that business uh, go when you first started the firm? Did a lot of new assets come right in right away, or was it a slow ramp up?
A slower ramp up. Although I was profitable during my first year, which my wife considers successful, which was great. God bless her, but it took a few years to get the first 10, 15 million under management.
Okay.
And then the last 4 years have just been ballistic in terms of growth. And
Great.
something like 50% annual growth in AUM every year for 4 years straight. In the first year, you're like, this is great. The second year is this is exhausting. The third year, you're booking flights to the wrong airport. In the fourth year, you're taking flights to the wrong airport. And,
So
at
great.
that point, I sort of had to take a year off to just rework all of my systems to handle the scale that my business needed.
Wow. So what are your assets now?
They are 75, 76 million. I am a solo practitioner and I do have some remote assistants, which are great. That was one of the best decisions that I've made was getting some help with the paperwork and administration. Highly recommend it.
And we talked about that at our conference a couple of weeks ago. And you work with a remote assistant, don't you?
That's correct. Yeah, I work with some folks out in Ohio. And one of the nice things about working with remote assistants is one, you only pay for the time that you use. And two, they already know what they're doing. So you
Right.
don't have to train them. You don't have to get them up to speed. And some of them are familiar with multiple systems, such as Morningstar versus Horizon versus Advisen, et cetera. And as a result, sometimes they can even guide you in terms of things that you might need to be doing.
Right.
So yeah, it's worked out really well.
Worked out really well. Good. So as you manage clients, how do you structure the portfolios? Do you run all the money, or do you source out some of the fixed income or other asset classes? How does that all work?
Sure, sure. So yeah, again, I'm an active portfolio manager, and what I've done is I've built 7 or 8 model portfolios that I use for clients to really get all the bases covered. My process for onboarding clients involves filling out not a risk questionnaire, but an investment personality questionnaire to see what they really want. Okay. So I think when you get right down to it, we're all a little bit crazy when it comes to our money because when you ask people, what would you like this to do? They say, hey, I want growth, I want income, and I want absolute stability. And you can't do that. It's not possible. You can sometimes get two. It's easy to get 1 out of 3. 2 out of 3 is a little harder. 3 out of 3 is impossible. So what I did is I gamified the process. So I have 7 different archetypical personalities. I give everyone 10 points to allocate to each of those personalities as would reflect them. And then in doing so, what my clients are actually doing is allocating their own investment portfolio. And it's genius. It works out super well.
So they're essentially allocating by their personality trait.
Exactly. And I have strategies that match the personalities.
Okay. Well, do you have somebody you could share with us, like a general uh, personality type, and then how would that lead to a portfolio?
Yeah. So I have a few, again, different strategies that I use. So some of the archetypes that I use, one would be upbeat Alan versus positive Patty. Who always believes that there's a bull market somewhere. They're interested in growth stocks primarily. Want to do solutions, not problems, and kind of think of themselves as like big picture investors. I have Dividend Dave, who's interested on generating income out of the portfolio. Typical Tom, who just wants to do mutual funds and ETFs. I have Fabulous Freddie, who's interested in momentum stocks and ETFs. And then I have Worried Will and Anxious Anne. And they just want to, go into the bunker for a while. And what I've found out is that if someone scores exceptionally high in the exceptionally risk averse category, they might not be a good fit for what I do.
Yeah.
So I think advisors kind of need to know their strengths and weaknesses and find clients that, that match that.
Fascinating. Great. So do you find that everyone kind of fits into one of those buckets, or is there some crossover that would change the portfolio a little bit?
Yeah, well, last year was interesting because in 2021, we all got to find out what clients' risk tolerance really were, right?
Really? Yeah.
Exactly. The people that said that they were aggressive but couldn't handle a 10 or 15%, downtick, they're really not aggressive, right?
Yeah. They're
So
aggressive, but they're not willing to put up with it. But the volatility.
exactly. One-sided aggressive. They like the upside, but they can't handle the downside. So I think it's important working with someone who really knows what your risk tolerance really is based on your experience.
Okay. So people's kind of personality, money personality,
Mhm.
can change in different markets as well, right?
It can. Now, my experience from last year is that the clients that were okay with risk tended to have higher income, they tended to be younger, and they tended to have a little more experience. The clients that were the most shaken by the bear market were primarily the retirees that were living off the portfolios. And if you think about it, this is kind of to be expected, right?
Of course,
Yeah.
we would expect. So once you've developed a personality, then how would it be that someone would change? Like what's the signal that their personality change or their risk tolerances change? What kinds of cues do you get, and when do you get them?
Yeah. One would be a life change, retirement, for example. The
Mhm.
second would be just experience. And I talk to all of my clients on a fairly regular basis, and they give me ongoing feedback in terms of whether they're comfortable or whether they're not comfortable. And we'll have a conversation and we'll make adjustments as needed.
Mhm. Nice. Um, well, good. And how often have you seen people change like their personality money wise? Do they change maybe just once as they get older, or is it in a bad market, or do most people keep their money personality the same all the time?
Most of them keep it the same. Yeah. But inexperienced investors are the most likely to flip, or nervous investors are the most likely to flip.
Okay. Interesting. Good. So then once you have the personality set up, what kinds of investments and different portfolios do you run for them, Jim?
Sure. I have a number of different strategies. I have two stock portfolio strategies. One is equity income, blue chip stocks. The other one's growth portfolio.
Hmm.
I have a defensive focused ETF portfolio and a growth focused ETF portfolio.
Hmm.
I have a sector momentum portfolio.
Hmm.
I have two market timing strategies, which is sort of interesting because market timers are kind of like the heretics of finance. Most people don't think that it's possible, but surprisingly, that's the area where I've been able to add the greatest value for my
Hmm.
clients is by managing risk through tactical.
Hmm. And what kind of tools do you use to manage risk within the portfolio?
Within those strategies or within the broad portfolio?
In the strategies, yeah.
Yeah, in the strategies. Yeah. So I've built a statistical database with over 200,000 data points to figure out cyclical, seasonal, and calendrical effects. And then I used artificial intelligence to figure out how much of those factors put into the sauce, right? So
Right.
think about spaghetti sauce. You need to have garlic, you need to have tomatoes, you need to have onions, and they need to be in the right proportions. And the same thing goes into a market timing model. You're trying to get the right ingredients in the right proportions. And I used AI to do that.
Okay. Good. Um, and how many different models do you run?
I run two models. I use the caffeinated model for people who like a little excitement, and I use decaf, the ones that get the jitters. Okay.
Yeah.
And they use exactly the same signals. One uses leverage. That's the excitement. That's the caffeine. And the
Mhm.
other one is unleveraged, in which I shift between an index fund and cash to manage risk. And I'm actually using that as a bond alternative. It's working out really well for that.
What are you doing? What are you doing now? Is that just that one bond alternative, or what are you doing for the I call safe bucket side? No longer bonds.
It's pretty short duration.
Okay.
Duration, and I use decaf market timing, which again has been really helpful for me.
Decaf. Did you say decaf market type?
Decaffeinated, yeah, decaffeinated.
So tell us about that. How do you do market timing in a decaffeinated way?
Yeah. So again, I have two strategies.
Mhm.
They both use the same signals, and I will switch between the Ridex funds and cash. Okay.
Okay.
So Ridex is a fund family that builds funds specifically for active traders, which is kind of a niche. And in doing so, you have no transaction fees coming in or going. You have 1 day settlement, which is great. And there's no limit to how many times you can come or go in the course of a month. So they've built a whole platform around people like me. And in my case, I'm using market timing as a risk management tool, and it seems to work for that. When you use leverage, you can sometimes outperform the market as well by doing market timing. Really add value there.
Mhm. Great. So let's talk about those strategies because that sounds very interesting. So if
Mhm.
you do market timing, and many people say you can't do market timing, but many of us who do know that it actually does work.
Yeah.
Um, how often do you trade out of the market completely? How often are you fully invested? Um, Talk a little bit about the structure of that timing process.
Yeah, well, it's really unique, right? So, as a futurist, you learn you only predict the things that you can reasonably predict, right? Like demographics for futurists, we love that because we're all getting older, and that's kind of a known fact. With market timing, what you find out is that there are certain patterns, rhythms, or cycles to things, and if you understand the pattern, the rhythm, or cycle, you kind of get a sense of what happens next. So what I do is at the end of each year, I gather all of my data for the last 20 years and then put together a trading calendar. This is my calendar, not a recommendation. This is my calendar for this coming year,
Okay.
where I estimate the probabilities of making money every given day for the next 12 months.
Mhm.
And then I print the calendar, I give it to my trading assistants, and then I walk away for 12 months. And it's one of those things where you can actually plan your vacation schedule around your trading schedule, which is almost unheard of in the industry. And the great thing about it as an SMA is that it works for really small clients because you're just in and out of one fund. It also works for really big clients because that fund is super liquid and it's
Mhm.
in a well-known index and you can trade it fairly actively.
So
So
the portfolio consists of one fund.
of one fund in cash. And we go from one to the other. It's totally binary. So the way that I use this in a client portfolio is you have the core holdings, right? You have your blue chip stocks, you have the things that you're going to hold on forever and pass on to the kids. But then you're going to have a satellite strategy on the edges where you're managing the risk. You're going in and out. And that's what the strategy is.
Nice. And you have two models. And what is the other model? This is the equity model.
Yeah,
right?
That's both models. And in one model, we use leverage, which gives you the top line returns. And the one without the leverage, I use instead of a bond allocation for conservative clients.
Okay, great. Are there any other bond funds involved, or is it just that equity or cash?
Not in that one. Yeah. And I really cut my bond exposure down 2 or 3 years ago. I was running 70-30, 60-40 portfolios like everyone else, but I couldn't get excited by, 2 and 3% interest rates. It's not something I wanted to lock into. So my bond exposure even now is pretty minimal.
Very limited.
Yeah.
So when do you think you might buy bonds?
One, rates need to stabilize first. Okay. That's the main thing. The Fed needs to demonstrate that they're going to stop doing what they're doing.
Okay. Do you use other asset classes and as part of an overall strategy, like commodities, currencies?
Yeah, I just did add some commodities exposure a few weeks ago, in part as an inflation hedge, but there's a long-term commodity cycle that should pick up at some point within the next few years.
Mm-hmm.
So, people who've done asset allocation, commodities have been a drag for the last 20 years or so, and they're beginning to show some signs of life. So I have a 5% commodities allocation.
Great. And how do you do that?
Yeah, I use an ETF for that.
Just an index ETF, or do you pick individual commodity?
Yeah, it's an index ETF. Yeah, I don't have enough breadth to trade my own commodities at this point.
I see. Okay. Very interesting. Well, good. So then you put it all together with financial planning. How do you do that?
Yeah, I do some financial planning through Orion Planning, the advisor platform, which they purchased about a year ago. They seem to be buying everyone out at this point. And that's a nice platform. I'll offer it to my clients on an as-needed basis. I don't feel that financial planning is something that should be done every year, but there are some things that you can do to optimize on taxes and take advantage of different retirement vehicles. So I'll do it when it's needed. Yeah.
Great. Fascinating. So, but only certain clients get it, not everyone.
Everyone gets it. Yeah.
Everyone gets it. Okay, good.
If they want it. Some people don't. It's a bit of a process. It requires some commitment on behalf of the client in terms of sharing and going into the details and creating the plan. It is more intensive than just having someone manage your portfolio.
I see. Well, great. So then how has your business grown then as you have clients develop and they're happy with you? Are they giving referrals, or are you asking for referrals? And how does it grow so much to 75 million?
Yeah. I don't actually ask for referrals. I try to delight the customer. I try to have a good relationship and get good results for them. And referrals just come in when they will. One of the things that I've done that worked out really well from a marketing perspective is I do have a monthly newsletter that I send out on Constant Contact. I have about 1,500 people on that list, and that always generates phone calls and emails for me. And I think the secret behind that, Brian, is to have your own content and to have your own voice. And I know that there are services out there that will write that content for you so that you can rebrand it and repurpose it for your own newsletter. But I think clients know if it's you or not, right? So you've got to be you.
Yeah, gotta be you. Very good. And you've written a book as well. Tell us about your book.
Yeah. Yeah. The book is called Foresight Investing, a complete guide to finding your next great trade. And it's the investing book that I always wanted, but it didn't exist until I wrote it. So if you look at my journey as an investment advisor, I've gone through a few different phases when you realize that there are a number of different perspectives of looking at the markets. You look at the markets based on the technicals, based on the price patterns. That's its own discipline. And if you really want to drill down in that, you get what's called the CMT, or the Chartered Market Technician designation. There's the advisors who really want to do the accounting and look at valuations and the fundamentals. And the designation for that is the CFA, or the Chartered Financial Analyst designation. And you'll learn how to do all of that. And then there are people that want to really look at the big picture, the big picture trends, the steep trends, social, technological, economic, ecological, political. And that's what my foresight degree was all about, is finding the next big opportunities for the next 10 years. And in the book, I talk about all three perspectives and how you can use those to manage your own portfolio.
And that's what you apply in your firm. So it's basically, the book is a description of how investors work with you.
Yeah. Yeah. It's my investment strategy, the whole book, 260 pages of how I do it.
Nice. So Jim, how did you get your largest client?
Interesting story. So we talked about referrals not too long ago, right? And one of the things, and you worked at a brokerage firm, and they tell you need to talk to attorneys, you need to talk to CPAs, you need to get referrals from them. And I never had success getting referrals from CPAs. And I've been in the business for 30 years, right? Until I got my first CPA referral, who was doing the taxes for one of my clients, who I grew from $3 million to $5 million in the course of 2 or 3 years. So what I did, said, this is great. This is the portfolio manager you should work with.
Right.
He was the $20 million.
Wow. So you developed the client. They didn't start with that. You developed them over time.
Well, it was a referral from a CPA that referred me to one of his clients. And that's how I got my largest client.
Oh, wow. Great.
And he did that by seeing my track record and looking at all the trades on the gains loss statement for one of my other clients. So he had an inside loop on that.
The inside track on that. Great. So success has been your referral source, essentially, right?
Correct. Yeah. Mm-hmm.
And what does the name StratFI refer to? How did you pick the name?
StratFI is short for Strategic Foresight Investments, which is a mouthful. So we just call it StratFI.
Very good. And then you've written another book as well, The Future of Everyday Life.
Yeah.
Tell us about that.
Yeah. That was a book that I wrote back in 2011, right after the first financial crisis. And it's about generational strategies for dealing with economic uncertainty. So I took some of the work by Strauss and Howe on The Fourth Turning, where they talk about millennials versus Gen Xers versus the silent generation, boomers. And they all have different money styles. And they all responded to the financial crisis a little bit differently. So I talked about that. I talked about some of the emerging trends that I saw, such as the sharing economy, which is Airbnb and Uber, such as alternative currencies, which we now call cryptocurrency for the most part. That was just starting back in 2011. I talked about digital nomads and the gig economy. So I was really on the leading edge of a lot of social change that was just starting to happen 12 years ago. So if you read the book now, it looks kind of obvious, which is good, because a good forecast should look obvious in hindsight. But it should look a little crazy first time you read.
Yeah. Yeah. Fascinating. Well, in all this work, Jim, you received the highest honor, Association of Professional Futurists, the most significant Futures Works Award. You've also won the National Association of Active Investment Managers, our group, the Active Investment Strategy Competition for the StratFI Caffeinated Market Timing.
Yeah, it got busy between the two of them. They both happened the same time.
Nice.
Yeah, yeah, they're both really good. It was an affirmation that, maybe I am crazy, but at least I'm functional. Good.
That's great. Well, good. So, Jim, this interview will be seen by about 300 financial advisors in the near term, next month or so, month or two, and then probably 1,000 people over the next year. So imagine yourself in a room with 1,000 people and you're going to tell them a good message today. You've given us some good insights. Is there any overall broad message that you'd like to share with our investment advisors about success and about your success?
Yeah, I think the key is really being true to yourself. And whenever you read or write or present to an audience, talk about the stuff that's interesting to you.
Mhm.
Because if you don't find it interesting, nobody else is going to find it interesting. Right?
Right.
So when I write my newsletter, I'm primarily just there because this is something that I find kind of intriguing, and I hope other people will too.
Mhm. Fascinating. Well, great. Well, this has been a great discussion, Jim. You're really very, very unique in what you do. And folks, the book is called Foresight Investing.
Yeah,
Uh,
here it
they
is.
should- there it is. And you can pick that up. We can get that on Amazon. We can get that on book buying service, right?
Yeah, absolutely. It has digital versions and hard copy versions as well. You can't sell books in the stock market by an audio book because the charts don't translate into an audio file. So you got to get
You got to actually read the book. Yeah.
you do.
Yeah. That's great. Well, good. Well, we'll all learn a lot of new, interesting things there, an expanded level of the things we discussed today. And thanks again for sharing. This is very unique stuff. And we really appreciate you being a guest on Financial Advisors Workshop, Jim.
Great. Thanks so much, Brian. Really appreciate the opportunity.
All right, folks, we'll leave it there. We'll be back again soon with another really great interview with a really unique guy, just like Jim. Thanks again, everybody. We'll leave it there. Have a good day.